I will take a quick moment and in full just vulnerability to say, guys, this has been so much fun. I've enjoyed this immensely. I have no idea sometimes how I become so fortunate and so lucky and so blessed to have people that will hang out with me across computers all across the world for hours at a time, and we're able to do it for a cause and for a charity and for a reason. And I think that is one of the most amazing blessings of my life. So thank you. It means the most to me. It's so impactful and so wonderful. And we have 2 hours left. This is where it gets hard. This is where I have to pee really bad. And it's like, doesn't matter. Let's focus in. Let's push through it. We got 2 hours to go. We can do this. This is the part of the marathon where it's tough. This is where you get tired. This is where your legs get sore. This is where your knees hurt. This is where you get hungry. This is where you get tired. We can do this. We got this. 2 hours to go. Here's what we're going to do. We're going to go back trade credit spreads, and then we're going to go back trade some options. Okay. We're going to back trade credit spreads. We're going to go back trade options. Now, how in the world do we back trade options? Doesn't even seem reasonable. Well, I'm going to go show you. Type a 9 into the chat pane if you want me to show you. So here we go. Remember how earlier I mentioned allow yourself to be a wizard. Allow yourself to come up with whatever you want anytime you want because you're awesome, because you're a badass, because you're amazing. How can you go create whatever world that you want to live in and just go make it happen for yourself? How can you do that? Well, here's the answer. You're going to want to pull up a stock. Let's pull up a random stock, 3M. Okay. This is going to be on the daily chart. And we're going to go back to, 3M's been around forever. So let's go back to like 2011 and we'll do January 1st, 2011. All right. And what we're going to do is we're going to use the principles of trading that are relatively easy, right? Where we say we're going to come up with a strategy, we're going to come up with a system, we're going to come up with something, and we're going to just trade it. All right. So what I'm going to do is we're going to back trade credit spreads, which this is a really, really cool strategy. Full disclosure, if you have no idea what credit spreads are, we teach you for free right here. Okay. So if you have no idea what we're about to talk about, because it is about to get a little bit advanced. So if you are a brand new trader and you have no idea what we're about to talk about, it's going to get a little deep. Okay. So I have free classes that go very, very deep into trading. I have some premium classes that go a little bit deeper. Um, I don't know if you have all have taken this class or not, but if you all haven't taken hedging with options, this program is ridiculous. It's the pinnacle course. It's the best of the best. If you want to watch these videos, these classes are also incredible. It's worth it. Okay. I would never sell you guys something that's not worth your money. And if you never like it, I will give you your money back. So for the 279 people who are hearing me say that, and maybe for the more who are watching this recording, I will give you your money back always, 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 always. Okay. So if you buy something from me, I don't care if it's a coffee pot and you're like, bro, this coffee pot sucks. I will give you your money back. Right? Money flows endlessly. It has no limit. So there's no reason why we both can't always be happy with our money. Okay. So what I want to do is we're going to practice a strategy. And I'm going to kind of help you with what I would do and how I would trade it and all the things. The very first thing I'm going to do is now that we're doing a bigger time frame, I'm going to zoom out to a bigger time frame. I'm going to draw some support and resistance levels. Okay, so I'm going to draw 4 lines on the screen and then I'm going to pull up my long-term averages. Okay, so here he is. Resistance right there, resistance, resistance. Oh, when I draw my lines, by the way, I always look to the left half of the chart. I don't ever look to the right hand of the chart. I look to the left of the chart. So I drew this line based on this guy. I drew this line based on this guy. And I drew this line based on this guy. So those are the 3 things that I looked at. And then, everything else just followed suit. Okay. So now what I'm going to do is I'm going to use two moving averages. So these are specific moving averages. I'm going to use the 100 and 200 simple moving average. Okay, so these are two specific moving averages, 100 and 200 simple. And what we're going to do is we're going to practice credit spreads. So I'll give a very, very quick explanation of what credit spreads are. And credit spreads is a strategy that allows you to have a very high probability win with risk exposed, and it's a probability based style of trading. So for traders who just have a very, very, very tough time in picking the direction or getting a winner together, I generally will help them start selling options. If they can't trade their way out of a paper bag, I'll initially help them with some option selling, because option selling is a very high probability trade. So if in general, I'm trying to get someone again to just start winning and to understand that the market's not rigged and anyone can make money, it just takes time, I get them in the option selling. Jason says you automatically are putting on a 66% probability. Yep, that's very, very true. Very true. So here's what you're going to try to do. What we're doing is you are selling stock insurance, and we're going to be getting into a bull put spread. Sell a bull put spread. That's the main strategy that we're going to be doing, is we're going to be selling bull put spreads. And what that compromises, what that consists of is selling a short put. Okay. Selling a short put, and then, oh boy, I'm starting to not type. All right. Buying a long put. Okay. So that's what you do on a bull put spread, is you sell a short put and you buy a long put. In this example, what we're going to do is we're going to sell the 85 and we're going to buy the 82.50. What's a good credit spread line? This one, spread trigger. Give me 1 second. I'm getting my brain's getting a little fuzzy and I got to break past this wall that's coming. All right. Sell the 85 put. Okay. Now there is a system and a strategy for you to figure out how much this option would have brought in, but I'm not going to worry about that. All we're going to do is just see if it works. That's it. We're not going to figure out how much money it would have made. It's irrelevant. It would have been worth something. I can tell you that for sure. It would have been worth something. I don't know how much though, but it would have been something. Okay. Buy the 82.50 put. And the difference between this, right? The difference is a credit. This does require margin. Okay. So this is a credit and it does require margin. All right. So let's do some really quick math just so you guys get comfortable. Let's say you sold 10 contracts. Okay. The 85 put brought in $1.25 as an example. And the 82.50 put, okay, you're doing 10 contracts, and the 82.50 put costs 79 cents. Let me guys show you the math that how much you'd be receiving. So what's 1,000 times 125? So 10 contracts. If you guys are options traders, again, if you have no idea what the heck I'm talking about, if you're just totally lost, you can either sit back, relax, enjoy, and hang out with me, or you can start taking our free classes where I'll teach you guys how to do this stuff. But each option controls 100 shares. 10 contracts is 1,000. So 1,000 times 1.25 equals 1,250. Okay, you guys good? And then 10 contracts at 7.9 is $790. So you would be receiving a credit of the difference of those two numbers. Does that make sense? Any questions on that? I'll pause here for just a second. This would be as much as I explain from here. Yvonne says, thank you, Jeremy. Got to run, hugs. Oh, Yvonne, it was the greatest day ever. Thank you. Javier says, I'm following. Terry says $460 of profit. Yep. And this would be April expiration. And by the way, you guys are gonna have to kind of slightly trust me on this one. I'm not leading you astray. This is probably pretty close. Just take my 12 years of experience. I'm getting you pretty close to this. Right, Jason? This is probably not like a stretch. This is probably pretty close. So I'm selling about a month away, $5 away from the stock price. It's going to be pretty much right on the point. Okay. So this would be a $490 profit. So here's how you win on this trade. If this stock closes above 85, we win. That's it. That's all that needs to happen. What do you guys think? Is that cool or is that cool? Only thing that needs to happen is it has to close above 85 for it to win. So let's just see if it works. Okay, did it close above? Yes or no? Uh-oh, you guys are getting tired. I can feel it. Let's try it again. 276 people here. Did we close above? Yes or no? Yeah, we just made 490 bucks. How cool is that? Amazing. Beautiful, beautiful. Okay, so we made some money. We locked in some profits, right? Awesome. So now we'll do it again. And this time we'll do it for June. Jose says, looks simple. It is. So I'm going to wait for a down day though before I get into the trade, and we'll find out when it expires worthless. I'll show you guys when it happens. So I got to wait for a nice down day to get into the spread. Okay, so this is a pretty decent down day right here. Let me make sure it's not an all-time high. It is actually. This is an all-time high. Okay, so let me wait a little bit longer. I got to wait a little bit longer, a little bit more of a selling event. That might have been it right there. There it is. There's the event that I'm looking for. Got it. Okay. So big sell off in May. I'm going to sell in June. And this time, instead of the 85, I'm going to have to do probably the 90 and then the 87.50. Okay. So sell the $90 put, buy the 87.50 put. Okay. And we'd make about $409 again. Now, if it stays above 90, so we will get into a trade where it doesn't. We will, and I'll explain what happens at that moment. Okay. But who can tell me how we win on this trade? Go ahead and type into the chat pane. Who can figure it out? How do we make money on this trade? Exactly. All it has to do is stay above 90. That's it. So it's kind of like roulette, except the odds are much better. It's actually a little bit better than 50-50. It's actually about 66%. Because here's the thing, a stock can only do one of two things. It can either go down, up, or sideways, right? That's it. So as long as it doesn't do this one, we're going to win. Now, if it does anything in between, so if it does up, this, 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 this. So the odds actually stay in your favor a little bit longer. Right? The odds are actually a little bit better in your favor. They're probably 70% without any actual analysis. And if you do your analysis correct, you can get up to high as 80. And then if you are a real life trader and you join real life trading, you start learning more about technical analysis and candles and so on and so forth, you can get them as high as 98%. 98%. In fact, for those who are here, let me flex our muscle a little bit. But here are some credit spread results. This is all time. Since we've been tracking our trades here at Real Life Trading, this is the all time win-loss ratio, 90%. ROI, 2,621% with credit spreads. What do you guys think? Pretty cool? Yeah. Now you're listening, huh? Cool. All right. So here's all that has to happen. It has to stay above 90 by June. Matthew says, are those from the official trades? They are. Yep. All right. So we're going to go to June. Okay. Did it close above 90? Yes or no? Did we win on the trade? Yes or no? Okay. Another winner. Yep. Now, here's a real question though. Would you have been losing on this day? Some of you might not know that, but the answer is yes. Your P&L would have been down. So your maximum gain on this trade is $490. You would have been losing probably about, I don't know, maybe $490. You'd have been down about $490. It wouldn't have been bad, but you definitely would have been losing money. You would not have been up. Okay, does that make sense? Now, here's what's really, really cool is now that this expiration has happened, look how close we are. I can actually go and do the same one again. I can probably go a little bit farther away this time. So instead of doing the 90, I can probably go back to the 87.50 and actually lower my risk a little bit. Because obviously you probably have figured this out, but the higher the option, right, the more likely you are to lose, and therefore the more likely, the bigger the reward. So I'll go back to the original one of 87.50, and then I'll do 85. So I go back to the original, and I'm have to sell on a down day. Fred says the bought put is for protection. Yep, that is correct. Okay, so we're going to do this one. I have to wait for a down day, and whenever we get a down day, I'm going to sell August expiration. Okay. All right, so there's your down day. I'm going to sell a credit spread on that day right there. Daniel says, I would love to learn how to mitigate risk on a credit spread. We're going to work on that hopefully while we're here. That's kind of the point of this. Oh man, this is so good. Well, this is going to be a nice winner. Oh, I spoke too soon. Cool. So now we'll get to talk about it. Oh, this is August. Sorry. Okay, that's fine. This is all good. So this is over earnings. Not a big deal. Not a big deal. But here's the thing. We're going to talk about this. We're going to keep this trade. Okay. We're going to keep this trade. So we would have gotten into the trade around here somewhere. Now, when the stock ran up all the way up here to its previous peak, this is just a trivia question. Could you have closed out the spread early to capture most of your profit? And the answer is yes. Yep, you definitely could have done that. And then you could have gotten into another credit spread over earnings, and it's gapping down. So I'm going to use this example. I'm going to stick to it. I'm going to say, okay, cool. This is a real life example. I'm staying in the trade. We're going to talk about how to mitigate risk. But first, I'm going to press the play button so we can learn a lesson for free. Okay, perfect. Now, this is worst case scenario. Okay. Do you notice how we are closing below, all the way down, below our strike price? You guys see that? Okay. This is the best example. I mean, I literally could not have scripted this better. I'm so thankful. Someone just asked earlier, like, what about how you mitigate risk or whatever? So you have your max loss. Okay. That's the good news, is you're losing your max loss. Okay. So your max loss would have been these two numbers. So, per contract. So you have 10 contracts. $2.50 per contract is $2,500 minus the credit that you got of $490. So this is your max loss on this trade. Now remember, we've already made $490 twice, so just keep that in mind. Okay. So you are losing $2,010 at close. Following me? Mo says, is it worthwhile having a stop on a credit loss? You already have that, brother. You have that, but bear with me. Give me 3 more minutes. I'll be explaining all of this. Okay, so everyone watching that, you guys good on that so far? Okay. That's just, relatively basic math. So now what I'm going to do is I'm going to explain when you could have protected yourself and why. And here's the part that I want everyone to understand. You still have to be good at technical analysis. Okay. That doesn't change. Like, you still have to know what to do at some point. You still have to know what to do. So let's go back in time. Now, I know that we can see what happened, but let's just go through where I stopped. Okay. This is where we stopped. And remember, I said, let's just press play so we can just see what happens so that I can help you guys all understand what would have occurred. Okay. So let's talk about a few things. Number one, what type of gap is that right there? Okay, that is a bearish gap and go. Are tons of buyers trapped? Yes or no? How many people do we trap? Well, if you draw a support line right there, so you trapped this guy, specifically this guy, all these lower shadows, all these buyers, tons of people are trapped. Okay. Secondly, if we zoom out, any kind of chart patterns that are apparent? Anything that kind of stands out a little bit? Anything that, might tell you that we could go down a little bit more? Any, pattern that might say, hey, bro, a little on the weaker side. So we got a double top. Okay. We have a bearish gap and go. Is volume increasing or decreasing? Increasing. Okay. Did we break both of my moving averages? Yes, we did. And if we zoom out, okay, if we put a lot of time on the screen, are we high or are we low? We're at all-time highs. Exactly. This is the all-time high right here. This is literally the all-time high right there. So would it make sense to like kind of eventually come down and like fill this void a little bit before bouncing? Yeah. Yep. Okay. So with all of those things, all of that being said, here are some ways to protect yourself in the form of a credit spread. Credit spread gone bad. Okay. Number one, buy more puts. Okay, that's one answer. Pretty easy answer though. The question that most people have is normally when. Well, let me show you. Would you buy a bunch of puts right here? No. On an up day or the break of a support. Yep, I agree. Okay, so here's a bull candle. Is that an up day? No. It's up from the open, but it's a down day. So we went lower than the previous day. Ginormous, beautiful hammer candle. And then the very next day, we close below that lower shadow. So You can buy more puts. Okay, that's option number one. That's choice number one. Buy more puts. Do puts go up when the market goes down? Yes, they do. So that's pretty easy. Okay. Now, number two, you can short shares. Okay, so you sell stock short. If you sell stock short, do stocks that go down, do you make a positive P&L if that happens? Yep. Now, number three, here's normally what I do. I normally unravel the position. Unravel the position. This takes practice. Timing is everything. Now, again, remember, number four, you could just do absolutely nothing and take your max loss. Do nothing, take your max loss, right? Yeah, I mean, you have a max loss. You have a built-in maximum loss. So, speaking of timing and max loss, Javier says we heard the flush. Nice. Cool deal. All right. So number four, do nothing. You have that choice. And right, you take your max loss. Do nothing, max loss, got it. All those are a possibility. Now, what your goal is to do when you're unraveling, right? This is what I normally do is I unravel the position. This takes practice. This takes timing. By the way, are we practicing? The answer is yes, right? This is free. This doesn't cost any money. This is just us learning. So when we're learning, this is our ability to sit back and go, okay, cool. I got it. I understand it. This is us taking the time, taking the moment, taking the magic to practice and get an idea and understand and all the things. All right. So here's what unraveling would require. Unraveling would require you to buy to close the short put. This requires a lot of cash usually. Now, why does it require cash? Well, when you originally sold the put, okay, when you originally, I'll come up here. When you originally sold the put, it was worth, I don't know, $1.25. Okay. Now that it's in the money, it's going to be worth a lot more than that. So now this sold put that was $1.25 is now worth probably $4.50, approximately, give or take. So if you, oh, sorry, this is $12.50. 12, okay. So if you sold for $125, now it's worth $4.50, and you did 10 contracts. So your 10 contracts you brought in, right, $1,250. How much would you have to spend to buy that option back? Yeah, so you'd have to spend $4,500 of cash. That cash would come out of your account. It's a big deal. Now, I'm not saying that as like it's scary. Like if you have the cash, if you have the money, like all is good. But that is something that you need to be cognizant of. Is like you need the cash available. Like if you're all on margin, if you're tapped out, like it can get hairy, scary real fast. That's why you never want to over margin. You never want to over leverage. You always want to have money available. You always want to have some cash available. Robert says, like that Google spread you had. Yeah, I'll talk about the Google spread at some point. Maybe I'll bring that up. Make sure you remind me, Falco. I'll talk about that. But yeah, so your net is you're going to have to spend the money. Now, in retrospect, you are also up on this option though. So keep that in mind. All right. Don't forget. So when you bought that option, right, you originally bought it for 75 cents. And right now that option's worth, I don't know, probably $2.50. Okay. So it's not as bad as we're thinking then, huh? Does that kind of make sense? Any questions on that? So again, the 85 put, that's our insurance contract. That's our hedge. That's our just in case this happens. But we do have the money available. We have it available. The option increased in value. The 85 put has increased in value. So now all we have to do is if the stock keeps dropping, right? If the stock keeps dropping, then we are able to simply sell this long put that we have. And if this sell is more than 450, we win on the trade. Does that make sense? So remember, we had to buy this one back. The cost 450. So if the option that we own, we can sell it for more than 450, we're good to go. And the only thing that would have to happen mathematically is the stock would have to move another $2, and we would do that. And that's all would happen. So if we come back to here, okay, closing below this lower shadow, right? The buy put, let's say we bought it for, what did I say, 75 cents? Okay, so we bought it for 75 cents. So we still own that put. Okay, this candle comes in, we're losing. This candle comes in, greatest day of our lives. We close the long 85 put for $5.25. Okay, so we originally bought it for 75 cents. So if we do the math on this one, if we do the math, 450 minus 125, and then we have 525 minus 75 cents. Okay. So 450 minus $1.25 equals $3.25 on the upside. So 325. And this math over here is 525 minus 75 cents, which is what we paid for it, right? 525 minus 75 cents, and that's 450. So the difference between these two numbers is our true net credit. 450 minus 325 equals $1.25. So we would have made on this trade $1.25 per contract, which is 10 contracts that we would have bought. So we would have actually made $1,250 on this trade. And there you go. How cool is that? Chris says, did you close the A750 put right when you hit that target? No, the purchase put would have been bought back somewhere over here. Yeah, the short put would have been bought back somewhere in that range. Because again, we mentioned all the reasons, right? The bear gap and go, the double top, the break below support. Mike says, how do you see the value of the put versus the stock price? I'm just giving you an example, Mike. You just have to trust me on this one. Yeah, I know it's not a great answer, but there are ways, but it's also just math, you know? Like if you have an 85 put and the stock is worth 82.23, it has to be worth at least 85 minus 82.23 minimum. Like it can't be worth anything less than that. So if you do 85, oh, that was too big. If you do 85 minus 82.23, it has to be worth at least that, right? Because it's an 85 put. And the stock is at 82.23. Jason says, if you really want to geek out on the stuff and go down the rabbit hole, purchase Hedging with Options and let Robert Thompson III take you there. Yeah, absolutely. Absolutely. Or there's so many ways you can geek out on this. I mean, we have a mentorship group that's going to cover just this stuff. So I think Tony has, let's see, two slots left. So if there's two people here that want to take Tony's class, it starts Tuesdays at 8 p.m. on the May 4th. May 4th, he's going to go over credit spreads, option trading and hedging, day trading, controlling emotions, all that stuff. It's a great class. I highly recommend it. $399 is a steal. It's you and 6 other people. So if you want to be in there, pop in. Okay. The rest are sold out. And if you think that this is fun, if you really like doing this, this is a guy that I've back traded with a lot. Right. So if you want to hang out, work out, spend some time with Yates, he has 6 slots remaining. Again, there's 269 of you here. So if you have never taken a mentorship group with Real Life Trading, I promise you from the bottom of my heart, it is worth it. It's very, very useful. Plus, you're going to make some friends and some comrades and some trading buddies that are, life-changing. So anyway, that's just a quick update on that. Thomas said you can also book individual sessions with any mentor. That is absolutely true. Ron says, so when you bought to close the short put on that update, what if it turned out to be a morning star and kept going? When would you have sold the long puts? Yeah, great question. So if I bought to close the short puts on that day and the stock just keeps on bouncing, you probably would have had to close when it broke above the most bearish candle. So I would have said you would have had to take the loss on the long puts if it broke above that candle. And that would have been worst case scenario. That is worst case scenario when you unravel the position and it doesn't work. That sucks. It sucks. And it can happen. So that's why timing is very, very important. I almost never unravel. I unravel my positions maybe 5% of the time. No, I'm talking about like that's after everything is said and done. I normally hold through it because very, very frequently it comes down and it bounces. Very, very frequently. Patrick says, do you ever roll? Rolling is the same thing as unraveling. I mean, it really is. Because you have to buy to close this put, sell to close this put, and then get back into the exact same trade. Or you sell another one down here. So it's still getting into a position. But that is a possibility. So let me include it. All right, let me include it. So number 4 is you roll, which I never do. Okay, number 4 is you roll, which means you exit this trade for a loss. Okay, take the L. And you get into a new trade hoping that it bounces in your favor. Yeah, so I don't do that one. Now, that's just me. I'm not saying that you can't do it if you want to practice it. But this back trading thing, the thing that we're doing right now, you can purposely go to when the market poops its pants and practice your unraveling skills. Practice looking at the candles. Ask yourself, when would you have gotten out? Why would you have gotten out? When would you have done it? What would have made sense? All those things. Tomas says, do you ever close before earnings? usually if I'm profitable, yes, absolutely. So in this situation, Tomas, when we were looking at it, when we got into the trade, right, we got into the credit spread over here. When it came all the way back up to this high, I would have closed it for a profit. Yep. I would have closed my spread to a profit, and then it obviously continued down. So what I probably would have done, full disclosure, is on this gap, I might have gotten into a bull put spread anyway, and I still would have had to unravel that bull put spread. So type a 2 into the chat pane if you want to see a real life example of when I had to do this. This is the last time that I can think of, unless Robert, you could think of another time that I had to unravel one recently. But it was on Google, and I will show you the exact time. Okay. Bang, bang, bang. Ross says, have you ever done credit spreads on futures? I personally haven't, no. Okay. So here it was. This is the event. Actually, sorry, let me go back to give you guys like context. Okay. So big gap down on earnings. I got into, I don't remember the exact spread, but pretty sure it was this one. Okay. So I got into it, gap down. If I remember correctly, it was a June week 1, something like that. All right. So here is the thing. Google, it's Google, right? So you're like, yeah, Google will go up eventually. So you get a big, strong bearish gap down. What type of gap is this? Yeah, it's a gap and go. Tons of people are trapped. People are losing money. All the things, right? Everyone's like, oh no. And me, like a genius, was like, oh, this will bounce. So anyway, I get into a bull put spread underneath the moving averages, the 100 and the 200 simple moving average. So I get into a bull put spread, and all is good in the world, right? So cool. I got into the spread, and it's going lower. It comes down to the moving average. I'm like, look at me. I'm the greatest trader in the world. Whoa. I'm so good. And then I'm like, oh, whoa, this isn't nice. So on that day, I'm like, okay, well, I mean, it's closing below the hammer. It closed below the moving averages. This was my warning sign. This was like, hey, bro, maybe you're a giant moron, and maybe you shouldn't be in this trade. Daniel says, could you have closed on that day for a small loss? Yes. Doug says, quick, buy a put. Yep. Again, you can buy a put to protect yourself. What I actually did on that particular day is I set up a limit sell to get into a bear call spread. So a bear call spread up here. Now the bear call spread will make money. It's the same as a bull put spread, except in reverse. It makes money if the stock goes down. So I set up a credit for a bear call spread, which filled on this day right here. So on that day, I got filled on my bear call spread. So now I'm in a bull put spread and I'm in a bear call spread. Technically called an iron condor. Okay. So now I can make money as long as it stays below here and above here. All right. So now this candle comes up and I do nothing. All right. Now I'm just waiting. And then this gap down happens. I was like, oh, that's weird. And then this candle happens, and then this happens, and then this happens. And that was a kind of a cute little hammer, right? But notice that the hammer is right on top of the 200 simple moving average, right? It's just hanging out right on top of it. So 200 simple moving average, right on, hanging out, doing its thing. A little bit of a bear candle. Again, nothing crazy. So is the stock still going sideways right now? Yes or no? Yes. Am I actually profitable on this trade so far? As of right now, the answer is yes. I actually am. I'm profitable. Barely, but I am profitable. I am making money on the trade. And then this candle comes in. And I said a 4-letter word. That 4-letter word rhymes with truck. Yeah, exactly. I said duck, D-U-C-K. Oh man. All right. And so what I did from here is, was my bull put spread in trouble? Yes. Did we close below my last level of support? Yes. So what did I do? I bought a put. That's what I did. Because we weren't in my spread yet, and I didn't have tons and tons and tons of time for expiration. But I bought a July put option. Patrick says just one. Bro, I wish I had your money, man. Dang. You know, I had, yeah, the options on Google are pricey. So I bought a longer term expiration. I bought a July protective put. So I had a bear call spread. I bought a July put, and I had this bull put spread still hanging out. Okay. You guys follow me so far? This is a real example. I did this day by day in the afternoon room. I was giving everyone the updates. All right. Next day, absolutely nothing. In fact, less than nothing. In fact, a sideways inside bear candle. And so I said, you know, since we have so close to expiration, let me close this for a loss, a small loss. So I did the math, because remember, this is the expiration. The expiration's coming up. It's right around the corner. Let me close this for a small loss. This gain right here will cover my small loss barely, but it will. Barely, but it was going to cover it. So I was like, if I exit now, I'll take the loss on the bull put spread. The bear call spread, I'll make like whatever, $100 more than the bull put spread, and I have a long put. So if it goes down, right? If it goes down, if it goes down. What is it doing down there? Yeah. Pretty crazy, huh? All right. So did the bear call spread work out? Yes or no? Okay. The bear call spread, this one up here. So the bear call spread worked out just fine. Was it a good thing that I closed the bull put spread? Yeah. All right. So I close out that bull put spread. Now, did the protective put make up for it? Yes, that would be a yes. Cindy says, could you have just bought to close the short put? And she's correct. I could have. So I could have just simply bought to close this one, and then I would have had 2 trades. That would have been ridiculous. That would have been the coolest thing ever. I did not do that though. Why did I not do that? I don't know. put on my jacket. I can't spend time to go and turn the thermostat on. I'm pretty sure I didn't put the heat on. It's like 40 degrees in my house. It's okay though. Daniel says lots of guts. Yeah, it would have taken you some serious stones to buy to close the short and hang on to the long, because expiration was right around the corner. That's the thing. That's why I did it the way I did it right here. Now, again, my friends, could you, I'm going to ask you this honestly, could you do this exact same style of practice right now, where you go and you sit down and you look at charts and you practice bull put spreads, bear call spreads, getting in, getting out. And it doesn't matter how much money you would have made. Would it have worked? Would it have not have worked? Where would you have gotten out? Why would you have gotten out? How would you have gotten out of it? Don't worry if it would have made you money or how much the options cost. It's irrelevant. And if you want, as Jason's mentioning, you can go and actually use Thinkorswim, and you can go back trade with historical option prices. Javier says, you don't care much about deltas when choosing what strikes to sell or buy. Not with credit spreads, no. JD says, no charge for practice. Exactly, because guys, I mean, really, you can, and I know it's initially sometimes feels like you can't make tons of money trading the stock market, but you can. You can. Promise. In fact, there is no limit to how much money you can make. But I would absolutely suggest practicing these things for a while. Right? Spend some time doing some credit spreads, and all the rules of everything else is going to go with credit spreads, right? Go with the trend. Don't try to bet against the trend. There's a lot of really, really powerful rules on credit spreads. Number one, don't say, oh, it can't go this high. Let me get into a bear call spread. That's a really dumb idea. Okay. Also, don't be like, oh, it can't go this low. Let me get into a bull put spread. Also dumb idea. Okay. Daniel says, do you align the number of contracts with your overall risk? Generally, yes. However, I mean, I do now, but when you first start out, if you have a smaller risk, Daniel, oftentimes you have to have a larger risk profile to do credit spreads. These are more of a probability-based trade than a pure risk-reward trade. Because you will and you can win 98% of these. It's the 2% that you do something stupid on that you can get hosed on, right? So you can win a lot. It's just the 2%. If you don't do it correctly and you do it with too much size or don't do it the right way, you can get really, really train wrecked. So generally what I suggest doing is using around 1/16 of your account, right? 1/16 of your account, and use that as your risk profile per credit spread. And then I suggest having no more than, a certain amount of your account in credit spreads until you have a lot of practice, until you have tons and tons and tons of practice doing it. Any other questions about that one? That was a great back trade. That was a super, super good tutorial. Really, really good stuff. Fred says, all right, everyone, I got to go. Yes, sir. Take care. Also, team, by the way, remember, you can do this on a smaller time frame. So if you want to practice weekly credit spreads, you could practice weekly credit spreads on an hourly chart. You guys ever thought about that? So you could do that on an hourly chart. You can go in and say, okay, well, if I was going to sell credit spreads every week or every 2 weeks, right? I'll sell spreads up here and sell spreads over here and sell spreads over here. Like, would it have worked out? You can do it on any time frame you want. Allow yourself to be a wizard. Allow yourself to sit down one day or multiple days a week and go, okay, this is the strategy that I'm going to test. This is the time I'm going to spend on this, and carve it out. Tell the wife, tell the husband, tell the kids, tell whoever, I need 4 hours on this day. I need 3 hours on this day. I need whatever time that you can carve out and go do it. It's all about a priority. You have to make this a priority if you want to make money trading. I promise. You have to make this a priority. Jason says, great stuff, bro. Hey, man, thank you so much for being here. Team, that was amazing. Type in a 9 if you're ready for the last hour.